Thousands of trucks ready for sale, just sitting unused in lots.
There's $867 billion in unsold cars suffocating America's lots right now. And if you're thinking about buying a car in the next 6 months, this could either save you $30,000 or trap you in the biggest financial mistake of your life. Right now, while you're watching this video, dealers across America are bleeding $127,000 monthly in interest costs on cars that nobody wants. We're talking about a mountain of metal built on pure pandemic greed that's now crushing the very companies that created it. Meet Sarah, a teacher from Denver who thought she'd never afford a new truck. Last week, she walked into a dealership and drove off with a $66,000 pickup for $39,900. That's nearly half off the sticker price. But Sarah doesn't know she's part of a much bigger story that's about to reshape how every American buys cars. Because in 2021, dealers flipped the script and turned scarcity into a business model. Empty lots became gold mines. New cars became unicorns. They gouged customers during shortages and laughed all the way to the bank. But now they're drowning in inventory and begging customers to take their losses. We got too cocky, one anonymous executive admitted to me yesterday. And now everyone's panicking. But here's what they're really terrified you'll discover. This isn't just about getting revenge on greedy dealers. This is about the complete collapse of the automotive pricing system that kept customers powerless for decades. The question isn't whether you can get an incredible deal right now. It's whether you'll know the difference between a genuine bargain and a financial trap that will haunt you for years. In March 2020, assembly lines went silent across Detroit, Kentucky, and Tennessee. The global semiconductor shortage hit without warning, freezing production at Ford, GM, and Stellantis. Overnight, the pipeline of new vehicles collapsed. By June, American dealers were running on fumes. Lots that once held 300 cars now had 30. Appointment-only sales replaced weekend crowds. Buyers lined up outside, hoping for a chance at anything with 4 wheels and air conditioning. The supply shock wasn't just about chips. Cargo ships stalled off California, containers piled up in ports, and essential parts, wiring harnesses, sensors, even basic plastics, vanished from the supply chain. In 2021, Toyota's US factories ran at half capacity for months. Ram shut down its Warren truck plant in Michigan for weeks at a time, sending thousands of workers home. The numbers tell the story. US vehicle output dropped by more than 2 million units that year, the sharpest decline since World War II. For the first time in decades, dealers had nothing to sell. Some brands, like Honda and Subaru, rationed inventory to their best-performing stores. Even the nation's largest dealer groups started hoarding what little stock they could get. Appointment books filled up weeks in advance. Test drives became a privilege. The old rules, negotiate, wait for a deal, shop around, no longer applied. If you wanted a car, you had to act fast, pay sticker, and maybe throw in a few thousand extra for the privilege. This was the first domino. Scarcity became the oxygen dealers needed to breathe. But behind the scenes, the chaos of empty lots was already planting the seeds for something far more dangerous. A new kind of leverage, where every missing truck or SUV became a weapon in the hands of the people who controlled the supply. Dealers didn't just ride out the storm, they turned scarcity into a weapon. Price tags became starting points, not limits. Walk onto a lot in 2021 and you'd see a $7,000 market adjustment sticker slapped next to MSRP. That wasn't a typo. On popular trucks and SUVs, markups soared past $10,000, sometimes $20,000 or more. You wanted a new Ford Bronco? That meant paying $15,000 above sticker, or walking. Even basic models weren't immune. Toyota Corollas and Honda Civics, once the safe bet for bargain hunters, came with $3,000 to $5,000 in mandatory dealer add-ons: window tint, nitrogen-filled tires, security etching, paint protection you never asked for. Try to say no, and the sales script kicked in. That's just how it is right now. Someone else will pay. Forced bundles became the norm. Dealers packed every deal with extended warranties, prepaid maintenance, and anti-theft devices, often adding $2,000 to $4,000 to the out-the-door price. Refuse, and the car was suddenly sold or unavailable. Some buyers reported being told flat out, "If you don't take the package, we'll move to the next person in line." Bait-and-switch tactics exploded. Online listings advertised one price, but in the finance office, the numbers changed. Hidden dock fees, reconditioning charges, and appearance packages appeared on contracts at the last minute. According to consumer watchdogs, 71% of used car buyers face these tricks, losing billions in surprise costs each year. The playbook was everywhere, from coast to coast. Domestic brands led the charge. Ford, GM, and Stellantis buyers faced hidden fees on 7 out of 10 deals. Imports weren't far behind. Even luxury brands, usually above the fray, joined in with their own exclusive adjustments. All of it was by design. Dealer groups held meetings to compare who could squeeze the most profit per car. Sales teams got bonuses for holding the line on price and pushing add-ons. Internal emails, leaked to reporters, called it maximizing the moment. For the average buyer, it was open season. First-time shoppers, young families, anyone desperate for a car, they paid the highest price. The system was rigged, and the house always won. But the gold rush came with a cost. Every extra dollar squeezed from buyers planted the seeds for the collapse now sweeping across America's lots. Inside the boardrooms of Detroit, the mood was triumphant. Minutes from Ford's 2021 strategy sessions show executives openly celebrating what they called a margin revolution. Gone were the days of chasing volume at all costs. The new mantra, sell fewer cars, make more money on each one. Jim Farley, Ford's CEO, told investors, "We are never going back to the old way. Lean inventory is good for profits, good for the brand." That wasn't just talk. Ford's gross profit margin soared to 9.85% in 2021, more than triple the year before. General Motors posted $10 billion in net income, selling 13% fewer vehicles. On Wall Street, this was gold. Analysts cheered as GM's CFO explained, "We're not returning to pre-pandemic inventory levels. Running tight means pricing discipline." Investor calls sounded less like auto industry updates and more like victory laps. Stellantis' Carlos Tavares put it bluntly, "We are going to limit our stock. That gives us more pricing power, less volatility, and better profitability." The plan was clear. Keep supply tight, keep prices up, and squeeze every dollar out of every truck, SUV, and crossover rolling off the line. Board presentations tracked not just cars built or sold, but average transaction prices and dealer compliance with margin targets.
Want to avoid the 17 car brands that will cost you the most money in 2025? Download our free ebook, Avoid the 17 Car Brands You Need to Avoid in 2025, and protect yourself from the biggest automotive money traps. Link in the description below.
Internal memos, paraphrased in trade reports, described controlled allocation as the lever for maximum profit. Dealers who played along with the new rules, pushing add-ons, holding the line on markups, were rewarded with premium inventory and factory bonuses. Those who discounted too soon found their pipeline drying up. The language was clinical, almost cold, optimizing inventory to enhance pricing power, structural capability for disciplined supply. But the intent was unmistakable. Scarcity wasn't bad luck, it was policy. For the first time in decades, the industry's leaders were united in their refusal to flood the market, even as American families were priced out. One executive, off the record, summed up the mood. "We finally have the upper hand. Why give it up?" The gold rush was no accident. It was a boardroom decision, executed with ruthless precision. And while the profits rolled in, The foundation for today's crisis was being laid, in plain sight, with the full blessing of every shareholder in the room. Software, not just scarcity, kept the price spiral alive long after the chip shortage faded. Allocation algorithms, lines of code written in Detroit and Silicon Valley, decided which cars reached which lots and at what pace. Dealers who played by the new rules, holding firm on markups and pushing high-profit add-ons, got rewarded with early shipments of popular models. Those who discounted too soon found their orders quietly delayed or swapped for slow-selling base trims. It wasn't just about moving metal. It was about enforcing discipline, one delivery at a time. The system ran deeper than most buyers ever realized. Automaker portals tracked every transaction, flagging stores that slipped below target profit per unit. Sales managers logged into dashboards that ranked them against peers, color-coded by compliance with factory pricing policies. A single click could see a dealer's next batch of trucks replaced with sedans nobody wanted. For the first time, wholesale supply was a weapon, and the software held the trigger. Incentives, too, were rewritten. The old bonus for selling the most cars in a region? Scrapped. Now, the fattest checks went to dealers who moved luxury trims and loaded options, models with the highest sticker and the biggest margin. Entry-level cars, once the backbone of the business, became afterthoughts. By 2023, more than half of all new vehicles shipped in the US carried premium packages or top-tier tech. The number of affordable models on lots dropped by a third in just 2 years. Suppliers felt the squeeze as well. Orders for basic seats, steel wheels, and cloth interiors dried up. Factories retooled for leather, panoramic roofs, and 12-inch screens. The chip funneling was real. Microprocessors earmarked for high-profit SUVs and pickups, while compact cars waited months for a delivery that might never come. The result? Even as production recovered, the mix was rigged. Dealers filled their lots with loaded trucks and luxury crossovers, each one a bet that buyers would stretch for the extras, or walk away empty-handed. The algorithms didn't just manage scarcity. They enforced it, shaping the market to favor profit over affordability. And with every click, the gap between what Americans needed and what they could actually buy grew wider, setting up the collision that's now crashing through every corner of the industry. By late 2024, the average monthly payment on a new car in America sits at $745. That's not for a luxury badge or a loaded SUV. That's the middle of the road. 4 years ago, it was $575. The difference? It's the price of groceries for a week, or the gap between paying rent on time and falling behind. For anyone with less than perfect credit, the math gets uglier. Subprime borrowers, those with scores below 600, are staring down interest rates of 15%, sometimes higher. That's not a typo. On a $40,000 car, it means paying nearly $14,000 in interest over a 6-year loan. Stretching the loan term used to be a trick to keep payments low. Now, 72 months is the starting point, not the ceiling. Dealers push 84 and even 96-month loans, with the pitch that it's the only way to get the payment under $700. But the total cost balloons, and buyers end up owing more than the car is worth the moment they drive off the lot. For families already squeezed by rising rent, health insurance, and food costs, the car payment has become the deal breaker. Nearly 1 in 5 new car buyers now signs for a payment over $1,000 a month. That's mortgage territory, not transportation. The average American household hasn't seen a pay raise that keeps up. Wages are flat, but the cost to get to work climbs every year. For those with spotty credit histories, it's even worse. Deep subprime rates, 18% or more, are common, pushing buyers into cars they can barely afford, with loan terms that feel like a life sentence. Dealer ads shout about discounts and fire sales, but when you sit down in the finance office, the reality hits. The payment is still sky high, and the fine print locks buyers into years of debt. The sticker shock isn't just at the showroom. It's every month when the bill comes due. This is the new normal for car buyers in America. High payments, high rates, and a shrinking path to real affordability. The promise of the open road now comes with a warning: miss a payment, and the repo truck is just around the corner. Used car values are in free fall. A 2022 Ford Edge that fetched $38,000 last year now struggles to break $25,000 at auction. That's a 34% haircut in just 12 months. For anyone who bought during the markup frenzy, the numbers are even uglier. Kelley Blue Book reports a 25% average drop in used values across mainstream brands since early 2024. The math is brutal. Buy high, sell low, and watch your equity vanish before the first oil change. Negative equity is now the rule, not the exception. More than 150% of new car buyers with trade-ins are rolling old debt into new loans, according to Cox Automotive. That means they owe more on their car than it's worth the moment they drive off the lot. The cycle feeds itself: higher prices, longer loans, bigger gaps between value and balance. For families juggling groceries, rent, and medical bills, the car payment isn't just a monthly squeeze, it's a financial trapdoor. Delinquency rates are flashing red. Experian data shows a sharp rise in missed payments, especially among buyers who stretched for 84 or 96-month terms. Subprime defaults are up 36% year over year. Lenders are tightening standards, but the damage is already done. Repossession agents describe a surge in pickups, SUVs, and even late-model sedans. Cars that would have been snapped up at any price 2 years ago now return to lots already overflowing. The pain doesn't end with repossession. Each vehicle that comes back floods the used market, pushing prices down further. Dealers desperate to move metal/prices. But every discount cuts deeper into the value of cars already sold. It's a race to the bottom, and every American who bought at the peak is caught in the collapse. The $934 billion inventory glut isn't just an industry problem. It's erasing household wealth, one driveway at a time. For families who once saw a car as their biggest asset, the ground is shifting. The promise of trade-in value, of building equity with every payment, has evaporated. Now, the only thing rising faster than the repo rate is the anxiety that comes with every monthly bill. 3 million new vehicles now sit unsold across the United States, enough metal to fill every parking lot in Manhattan, then spill out into the suburbs. The number sounds impossible, but it's stamped in black and white on industry reports. Ford, Jeep, and Ram, each with over 100,000 units languishing on lots. Even Toyota, the leanest of the giants, holds more than 250,000 unsold cars, turning what used to be high-turnover inventory into a silent, gleaming blockade. The days of 30-day supplies are gone. National averages now hover at 79 days, but for some brands, like Ram, the count stretches past 149. Overflow lots have become the industry's open secret. Satellite images show rows of new trucks and SUVs packed nose to tail at abandoned airfields, stadium parking lots, and fenced-off desert compounds. One analyst tracked more than 400,000 vehicles hidden in just 3 remote sites. Cars so fresh, their window stickers are still in place, but already their batteries are dead and their tires are flat. In Houston, Los Angeles, and Newark, port authorities confirm record off-site storage since late 2023. The official inventory number, $150 billion in unsold cars, barely scratches the surface. Social media sleuths and market analysts estimate the true value could be 5 times higher when you count everything warehoused, stored, or simply written off as aging units. Every week, more trucks arrive from the factory, but fewer leave. The result? A mountain of unsold inventory, growing larger by the day, suffocating dealers and factories alike. What was once a symbol of American prosperity, a lot full of new cars, has become a monument to excess, and a warning that the system is cracking under its own weight. Every unsold car on a dealer's lot isn't just a missed sale. It's a bill that grows every day. The industry calls it floor plan financing. Dealers borrow millions from banks or automaker captives to keep their lots stocked, paying interest until each car is sold. When inventory was tight, the cost barely registered. But with 3 million new vehicles clogging lots and off-site graveyards, the math has turned brutal. Interest rates that hovered below 3% a few years ago now sit at 7%, 8%, even 9%. For a large dealer with $18 million in inventory, that's a $127,000 monthly interest tab, more than double what some stores paid in 2021. It doesn't matter if a single car leaves the lot. The debt clock keeps ticking. Every Ram, Ford, or Jeep gathering dust racks up $50 to $80 in daily holding costs, draining cash from the business before a single deal is signed. Manager memos circulate with a single message: move metal at any price. Some stores slash $20,000 off sticker. Others blast out mass emails offering 50% discounts on slow-selling models. The goal isn't profit, it's survival. Every week a car sits unsold. The floor plan bill eats away at what little margin remains. For some, the interest alone now swallows half the gross profit on each sale. Desperation is everywhere. Dealers who once boasted about record margins now beg lenders for relief or plead with automakers to stop shipping new units. Internal emails show managers ordering fire sales, telling staff to take any offer above invoice just to keep the lights on. The longer the inventory glut lasts, the closer more stores get to the edge. Mike Rodriguez unlocks his dealership at sunrise, but the numbers waiting on his desk are already a gut punch. He runs a multi-franchise lot outside Dallas, where every unsold truck parked in the back row is another weight on his chest. Last year, Mike's store cleared 3% profit on each new vehicle. This month, after paying $127,000 in floor plan interest, his margin has collapsed below 2%. Some days, the interest bill outpaces total payroll. Each morning, his finance manager prints a fresh report: 211 new vehicles, $13.6 million in unsold inventory, and a daily interest charge nearing $4,300, more than he pays his service director in a week. The showroom feels emptier than the lot outside. Salespeople scroll their phones, waiting for walk-ins that never come. Mike's office door stays closed longer now. He's fielding calls from the bank, from his manufacturer's rep, from vendors who want their checks. He's tried everything. Mass emails with $15,000 discounts, zero down offers, even a buy one, get one half off weekend. Nothing moves the metal. Every week, another truckload arrives from the factory. He pleads with the automaker to slow shipments, but the system is automated, the deliveries relentless. His best salespeople whisper about jumping ship to Toyota, where inventory still moves and bonuses mean something. Mike's not alone. Across the country, dealers like him are watching the floor plan clock eat through years of savings. The math is unforgiving. Sell at a loss or risk losing the store. For the first time in his career, Mike wonders if surviving the next 6 months means breaking every rule he once swore by. When desperation becomes policy, every deal is a gamble, and every customer is a lifeline. Buried in the paperwork, the real cost of that so-called bargain starts to show its teeth. Dealers aren't just discounting trucks, they're rewriting the rules in the finance office. The hottest pitch in 2025 isn't a low price. It's a low monthly payment, stretched over 84 or even 96 months. That's 8 years of debt for a car that could lose a third of its value before the first set of tires wears out. On a $40,000 loan at today's average rates, the difference between a 5-year and 8-year term is more than $7,000 in extra interest, enough to buy a used Civic outright. But the math gets murkier with every signature. Bundled into those contracts are $2,000 protection packages, gap insurance, wheel warranties, prepaid maintenance, sometimes slipped in as line items, sometimes buried in fine print. The finance manager's screen flashes with options: paint sealant, anti-theft tracking, even etching the VIN into the windshield, all presented as must-haves. Say no, and the monthly payment suddenly jumps, or the approved rate disappears. Variable rate loans are back too. Dealers dangle teaser APRs that reset after 36 months, turning a $600 payment into $800 with one letter from the bank. Some contracts carry stiff penalties for early payoff, fine print that locks buyers in, even if rates fall or values crash. For anyone trading in a car bought at peak prices, negative equity gets quietly rolled into the new loan. The monthly bill looks manageable, but the total balance grows, sometimes by thousands more than the car's worth. Every add-on, every clause, every extra month on the term sheet is another way for the dealer to claw back profit lost on the front end. The sticker price is just the start. The real trap is in the numbers you don't see until it's too late. For buyers chasing a deal, the fine print can turn a dream purchase into a financial anchor that drags on for years. The next 12 months could decide who survives and who vanishes from the American car market. Analysts warn that nearly 2 out of every 3 dealerships, 67%, face closure or forced consolidation if floor plan costs and inventory gluts persist. That's not a distant threat. It's already happening in small towns and city suburbs, where once busy showrooms now sit dark, their lots crowded with unsold metal. The math is relentless. Every vehicle parked for months drains cash, and every fire sale cuts deeper into what little profit remains. But for buyers, the chaos brings a strange kind of leverage. The old rules, never pay sticker, walk away from hidden fees, are back in play, but with a new twist. Dealers desperate to survive are slashing prices, waiving add-ons, and sometimes breaking their own software-imposed minimums just to move units. In the right hands, a little research and a willingness to walk away can turn the tables. Some shoppers are saving $10,000, $20,000, even $30,000 on new vehicles, if they're patient and know where to look. Yet danger lurks behind the deals. Electric vehicles, once hyped as the future, are now the fastest depreciating segment. Some models lose 30% of their value in a single year. A new electric vehicle that seems like a steal today could be worth thousands less by next summer, trapping buyers in negative equity. Deep discounts on gas trucks and SUVs often hide long loan terms or variable rates that balloon after the first 3 years. The risk: a bargain that turns into a financial sinkhole. Transparency laws are inching forward, but for now, the burden is on buyers to read every line, question every add-on, and compare offers across state lines if needed. The industry's pricing system is cracking open, and for the first time in decades, the power is shifting, if you know how to use it. The window won't stay open forever. As factories cut production and automakers pivot to made-to-order models, today's desperation could vanish overnight. The next move belongs to the consumer. Right now, over $934 billion in unsold cars sit on American lots, an unprecedented glut created by years of engineered scarcity and soaring prices. Internal documents and earnings reports confirm that automakers like Ford and GM prioritized margin over volume, while dealers charged thousands above MSRP through 2022 and 2023. As monthly payments hit record highs, averaging $745, and values crashed by 25%, everyday buyers were left holding the risk. Now, dealers face $127,000 a month in floor plan interest, with as many as 3 million vehicles sitting idle and 67% of dealers at risk of closure. Yet, the full extent of boardroom strategies remains sealed in confidential transcripts, and the true long-term impact on families is still unfolding. What is clear: the collapse of this profit-driven model has put the power and the risk back in the hands of buyers. Every contract signed today is shaped by this history, and the next move belongs to the public.
Want to avoid the 17 car brands that will cost you the most money in 2025? Download our free ebook, Avoid the 17 Car Brands You Need to Avoid in 2025, and protect yourself from the biggest automotive money traps. Link in the description below.